Right, good morning everyone and welcome to this update. To those of you joining online, today we need to discuss the Constitutional Court judgment, not the one yesterday about the money being put into furniture. This is the Absa case, which has been commented on widely, and I think has been slightly pulled out of context in many instances on its commentary. And what I want to do today is I just want to take you through briefly the facts, and then what the court decided, and then what the commentary seems to be about, the commentary that's been published, and I'll give you my criticism on the commentary and what I think the judgment actually says. Right, for those of you joining online, as per usual, it's for your interest only. This training is designed for my staff, the guys joining from my office. For online, it's just for your interest's sake. All right, so let's look at the Absa fact simplified. So what Absa did is, typically through funding mechanism, they invested in preference shares. And the reasons that banks typically invest and make preference shares or subscribe for preference shares is it gives them exempt dividend yields as opposed to borrowing company money and earning interest, right? So that's the main reason, or I suppose one of the reasons, that often you will find the use of preference shares, often redeemable preference shares, because that's very similar to debt, right? So they'll subscribe for redeemable preference shares and they get tax-exempt dividends. Now, SARS' issue is, I said, that when you look at how this money flew, so SARS, Absa, you guys sat at the top, you subscribe for preference shares and call it Subco 1. Subco 1 in turn subscribed for preference shares in Subco 2, and from there on there was a strange transaction, which is not explained anywhere, where they go and invest in debt that's interest bearing, and then they swap that to interest-free debt, right? And then the money flows back as interest-free debt to the structure, and then as tax-free dividends up to ultimately Absa, right? That is the issue. But SARS said, but there where you swap the interest-bearing or the taxable interest for interest-free, a tax-free interest, there's a tax benefit downstream in this structure. And we don't like that. Even though, Absa, you didn't directly get that swap of the interest-free or tax-free interest, you benefited from it, right? And the core issue then ultimately for determination in this particular case is, well, one, is there an impermissible avoidance arrangement? I will deal with that swiftly, but the biggest issue on the commentary are these two second steps is, could Absa be a party to this GAAR arrangement if they didn't know about all these downstream steps in Subco 1 and Subco 2 and the conversion of the interest-bearing or tax on interest, or the taxable interest and the conversion of non-taxable interest, that they didn't know about that? Can they be a party to the arrangement? And that's where much of the commentary has been. We'll talk about that. And then also is, can SARS, if the tax benefit was lower down in the structure, call it Subco 1 and 2, can SARS go and then raise the tax assessment on Absa? Because Absa's view, as I read it, and as you read the minority judgment, but I'm not going to comment on the minority judgment, I think the majority fairly sufficiently critiques the majority judgment, and rightly so, in my view at least. The question is, can SARS just go and raise, on Absa, because Absa subscribed for preference shares, that's very normal. Subscription for preference shares that yields dividends is normal. There's nothing untoward about it. It is tax-free by design. Preference dividends, or dividends, is tax-free. There are, of course, certain anti-avoidance rules, especially with preference shares, but it's by design, it's tax-free. And so the question is, you know, if they didn't get the tax benefit technically, can SARS go and raise the assessment on them as opposed to somebody down in the subsidiary? And the argument was, it was where the interest was swapped from tax-free interest to taxable interest because of the use of certain, I don't want to get into it because I'm speculating. If that's where the benefit was, should SARS not, surely they should go and raise the assessment there. And insofar as, and I'll go through the court's judgment fairly quickly, the court says, look, if you look at this arrangement holistically and not the individual steps, so it's where Absa subscribes for prefs, and then from there to prefs down, and from there it went out to some trust, and from there to Brazilian bonds, and whatever the case might be. I don't have to look at them. I don't look at them separately. I look at this whole transaction, and I look at the whole, every step, even in the downstream steps, to determine objectively what is this arrangement, and is it an arrangement that falls subject to the GAAR? And the court says yes, it is. Right? We can get very technical about this, but I don't think it's necessary to get technical. Let's get to what this means for taxpayers generally, right? Not what it means for complicated financing transactions, because there is a message in here for general, normal taxpayers that are not big banks and big private equity houses and those guys that typically do these structured finance deals, right? And here's the second issue that I said is the biggest issue, it seems, where most of the commentaries come from, is who is a party to an arrangement, because you can only address and raise an assessment if you're a party to the arrangement. And what Absa's point was, is they said, so they argued, we will see, by the way, this is important to understand, the actual dispute, right, the actual assessments being disputed is still at tax court level. SARS is still challenging, as far as I could tell, SARS is still challenging Absa's allegation that they did not know about the downstream steps in the transaction. SARS, the taxpayer here, took this on review on the basis of SARS's ATJ notice saying, we accept you didn't know, right? So they said, well, on that basis, you can't tax me, so it's a legal dispute only. So that's why the court ultimately decided and why the High Court held this is a different discussion. But here the question was simply, if we accept that Absa didn't know about those conversion of the interest, taxable interest to tax-free interest, can they be a party? And the court says, yes, they can be a party. The question is whether the taxpayer objectively formed part of a chain of transactions, right? Not whether you had knowledge of it. And the court, in what I think, with respect, is one of the most beautifully penned judgments written in the last however many years on tax disputes. It wonderfully explains how they come to this conclusion. And they come to this conclusion to say, when we look at certain amendments made to the GAAR, roundabout of, I think, I forget now, but I think it's around about 2006, they moved away from the subjective interpretation, the subjective, did you have knowledge, did you know, etc., exactly to avoid positions where someone like Absa could say, I'm just going to give them money, I'm going to turn a blind eye, and what happens downstream, I don't know. No, it's hear no evil, see no evil, whatever kind of thing. That the court said exactly how they changed the GAAR, is to say, let's not look at it subjectively, let's look at it objectively. And so, simply put, Absa was a party because it participated in the transaction. And here, I think, is where, so a lot of the commentary felt on party, but I think most of it, and the unfairness of the judgment, or the perceived unfairness of the judgment, I should say, comes from the court's holding that SARS is not limited, or the GAAR does not limit SARS to tax the party who actually obtained the tax benefit. Because as I understand Absa's position was, I subscribe for preference shares. Preference shares yield exempt dividend income. I didn't do anything odd here. Somebody did something odd, I'll grant you that, or it seems to me that I'll grant you that, but it happened downstairs somewhere, right? Down in the chain. They got the tax-free interest, which was supposed to be taxable, right? And so they said that you must go and tax them. You can't tax me. There's nothing wrong with the tax-free dividend. And the court said no. If you read it, the GAAR doesn't say SARS must tax the one who got the tax benefit. It says SARS can raise the assessment on anyone. And that is where I think most of the commentary is where they get a little bit, I think they get a little bit off topic. For those of you joining late, these sessions are recorded on the Unicus Tax YouTube channel together with all the other sessions we've done so far this year. So you can check them there. But the common commentary and the common issue, it seems to me, as far as I read it, about the judgment is it seems to say that the court has looked at this way too broadly, because now SARS can go and they can pick any participant at random and raise an assessment on them. And how unfair is that? Because indeed, when you consider that the judgment of the court, then that does seem unfair. I mean, if you have no idea what's going on in the transaction, and all of a sudden you get a knock on the door, SARS says, listen, 7, 8, 9 transactions away from you, somebody dodged tax, so I'm going to raise an assessment on you. I get that. I also go, but that doesn't sound right. But I think, with respect, I think that commentary reads the judgment a little bit too bluntly, right? In my mind, the court, and remember, and one of the reasons I think that commentary is too blunt and reads the judgment too bluntly is because when I put it in the way that I've explained it, that SARS can tax anyone at random, I'm removing the facts of the Absa case from the decision of the court. And we know that that's not how we interpret tax or court judgments. You cannot remove the facts from the case and say that's the principle, right? You must always read the judgment on the facts of that particular case, right? And that's the precedent that it sets, is on the facts of that case. And what the reality is here, right? When I read this judgment, even though the court does use broad language, I cannot deny that. The court does say any party can be taxed, right? And you don't have to have knowledge to be a participant, to be a party, you just need to participate. But when you look at the facts here, the reality is that that tax-free conversion, where the interest escaped tax, the benefit of that tax-free portion of the interest flowed through, as a conduit, flowed through and landed at Absa, right? The court goes as far as to say that Absa did get a tax benefit in this case. With that, I think, with respect, technically I disagree. There was a financial benefit that got to Absa, right? But the reality is that the benefit of the tax not being paid because of this chain of transactions on what is effectively taxable interest landed at Absa, right? And that you cannot distinguish, you can't remove that fact from the judgment. And I think the benefit, or that when you read it like that, it's not like SARS can say, let's go to anybody randomly and let's tax them. We need to see where the tax benefit lies, and that's important because that distinction changes the way you read and interpret this judgment, right? If we said, let's take, for example, I had this debate with Vickers when I read the judgment, which again was fantastically written in my mind. In my mind, when you read the judgment, let's assume for a second that somewhere down the line in this scheme of transactions, or this, this conduit principle, subcode 2 absorbed the tax benefit and declared a lesser yield as a preference dividend up the structure, and Absa received less. I don't think SARS would have succeeded with raising the assessment on Absa. It's not a case of SARS can tax anybody at random. That's not, I think, what the judgment in the context and facts of this particular case says. Yes, it uses broad language to say that SARS is not limited to where the tax benefit is. But I don't think SARS will succeed in saying, hey, Consul, or hey, Aviwe, or hey, Vickers, or whatever, you know what, you bought a chocolate at Checkers, you know what, the supplier Cadbury somewhere 3 years ago did some deal, so we're going to come and get the tax from you. I think that's the wrong way of looking at it. Right. So I think the right way of looking at it is, where is the actual tax benefit, right? Where does it lie? So the practical example, I'm going to use this again, and I know we discussed this last week, but I want to use the example for the audience because it is a nice way of taking the edge of this unfairness perception that one gets from the judgments, the VAT example that we discussed last week. Now, for those of you joining online, I'm not saying that SARS can use the GAAR in this example. I'm using it to explain the principle, right? Let's say, for example, and if we use a common example that I think happens more often than one would like to accept in practice, is you are doing home renovations, right? And you get a contractor in, and the contractor says to you, listen, pay me cash, and then the price will be 15% cheaper, right? And that's all they say. You don't know tax law. You don't understand that the guy is dodging VAT because you're paying him in cash. You have no idea. You just think, well, it's like a cash discount. Fantastic, right? And you enter into that transaction, right? Who gets the benefit of that? Hang on, let me ask this question. Who's dodging the tax? The supplier, the contractor. Yeah. He's the one who's dodging, or she or it is the one who's dodging the tax. But are you paying less because tax is being dodged? Yeah. So once you look at it like that, does that not remove this unfair feeling of SARS can tax anybody in a GAAR arrangement? That seems to me, because you would have, if the tax was properly paid, you would have paid 15% more, right? So if SARS comes and they raise the assessment for the 15%, that seems fair now, right? I'm not saying that's how the GAAR works. I'm not trying to suggest that that's how SARS would apply it in practice, but it explains the principle. And so the way I think taxpayers must look at this judgment, because lots of people look at this and say, oh, Absa, it's a large bank. We're not going to do preference share transactions. We're not going to do this. It's too complicated, blah, blah, blah. The question, I think, or the takeaway for taxpayers is, and we get this often. Just a few weeks ago, I was asked by someone to issue an opinion because somebody said to them, invest in this structure, and because the taxes is done in a particular way, you get a higher return on investment. And that's when they said, no, I want Nico to check this because something is wrong here. And it was right to ask that question. Because if you enter, if you're a taxpayer and somebody comes to you and says, listen, if you make this investment, there's going to be exceptional yield, right? There's going to be a commercially better outcome than anything else. And the explanation isn't because the product is better. The explanation is just the tax mechanics, right? And you don't need to know. You don't need to know. And if you ask questions, and you'll find this often, as soon as you start asking questions, the answers start becoming vague, right? No, councils, I've got it in the slide somewhere. You'll get answers like, don't worry about the tax, it's not your problem. So the tax is paid elsewhere, right? Don't worry about this, council side off on this, right? I'm going too quick on my slides. Don't worry about this, it's not your problem. Unfortunately, if you participate in an arrangement, you need to know if there's a tax benefit and whether or not that tax benefit is being passed on to you and whether or not it's a GAAR thing, because it determines whether you're at a risk, whether this investment or whatever this transaction is you're doing carries some form of tax risk. Because even though it might not you not paying the VAT over in my rudimentary example and dodging the tax, it might be you gets the assessment from SARS. Right? Now, I'm not trying to suggest that everywhere where there's a scheme designed around a tax benefit that it's always GAAR, because there are legitimate tax incentive schemes out there. Tax-free investments is one of them. I forget the section. But you all know the tax-free investments, you get up to X amount investment. So that's fine. But typically, if it's a legitimate tax benefit structure, you will find lots of it published publicly. Right? You won't struggle to find an explanation as to why this is tax efficient or why this is a better scheme. We know that tax incentives, we can Google it, you can find it on SARS's website. But if the explanations become vague and unsupported, or you don't need to know, or council signed off, or the tax benefit is somewhere else, be cautious. I'm not suggesting that there is tax avoidance, and not at all. I'm saying be cautious, because the court has now said that it can in fact become your problem, even if technically you're not the one to get the tax benefit. Although in Absa, the court said Absa does get a tax benefit. With that technical point, I disagree, but the logic is fine. So my view is Absa is not a judgment, I think, that says SARS it says anybody at random, anybody in an avoidance arrangement at random. I don't think the court does say that is that wide, but in the context and the facts of this particular case, I think the proper reading of it is SARS was going to look at where the benefit fell. Where the benefit fell. The benefit was absorbed somewhere down the structure. I don't think SARS would have succeeded with their GAAR assessment, but then I don't think SARS would have raised the assessment there in the case, right? Right, so I think look at whether or not there's a tax benefit or whether the value is being passed on to you, and understand how the savings work, especially if somebody says it's tax, right? Too often I get vague, and then you get people, it's almost as if they think they are very fancy, because when you start asking questions, they use all these fancy jargon terms to try and make you feel stupid, so you don't understand what's going on, right? I've dealt with many complex finance transactions, right? And they all like to, especially certain, not all, but certain finance guys will say, yeah, that, and you short this, and you do this transaction, and then it's absorbed in the fund. And I go, hang on, people, can you just explain to me what the transaction is, transaction for transaction? Don't talk to me about overall and counsel this and counsel that. I want to understand legally what the transaction is, because legally there's a transaction. Everything you're doing is a transaction. You need to explain to me what's the steps of that transaction, right? And then you'll find you start getting vague answers because the person you're speaking to probably doesn't know what the transaction is, right? And I'm not saying that's always a red flag. I'm saying just be mindful of that, especially if somebody says something about, no, but the tax is the reason for the cause. Don't confuse my comments here on legitimate tax incentive schemes, of which there are many, but this judgment does go further. And if you look at the effect of this judgment, saying the benefit ultimately landed at Absa, then the judgment stops feeling as unfair as it might seem.